It's the 1st of August, 2015, and this is episode 235. This show is intended for informational and educational purposes only. What cryptocurrency enables is new, empowering, and exciting, but we're not experts. Just obsessed companions walking the road towards a more peer-to-peer future. Hey folks, Adam B. Levine here. On today's episode of Let's Talk Bitcoin, we're in New York for the recent American Banker Conference on digital currencies and the blockchain, courtesy of Counterparty Community Director Krista Rose. We spend the bulk of today's show with Blythe Masters for her keynote speech, but first, a few words from Marc Hochstein. We join him now.
Good morning, everyone. Welcome to American Banker's second annual Digital Currencies and the Blockchain Conference. My name is Marc Hochstein. I'm the editor-in-chief of American Banker, somehow. I'll be your MC for the day, and we have a fascinating and jam-packed program for you. Before I introduce our first keynote speaker, I'm going to ask you to indulge me for a few minutes. Today, we're going to be talking about a young technology and a new field of study that has come a long way in a short time. The fact that we renamed this conference from Digital Currencies, which was the name last year, to Digital Currencies and the Blockchain says a lot about how the conversation has evolved. You will be hearing a lot today about how the space is rapidly maturing. You will be hearing about commercial uses of distributed ledgers, about applications of this technology that go beyond money into areas like property titles and securities clearing. You will be hearing about how amateur hour is over. The grown-ups are coming into the space. You will be hearing about permissioned ledgers and private blockchains. And I'm sure you'll be hearing about how financial institutions can harness the power of this technology in a compliant fashion. All of this is well and good. Any technology that helps banks to serve their customers more efficiently is a welcome innovation worth exploring. However, I'd like to say just a few words in praise of the thing that started all of this, Bitcoin, and not the blockchain, Bitcoin. I'm not going to opine on the price. For all I know, it could go to zero tomorrow. I'm going to talk about how Bitcoin, the idea, has made me a better editor at American Banker. Not because we've been writing about Bitcoin all that much, but because Bitcoin has cast everything that came before it in a new light. How many of you here have heard of the term red pill? For those who haven't, the phrase comes from the movie The Matrix. Put simply, a red pill is something that makes you see previously obscured realities and doubt things you might otherwise have taken for granted. I've been with American Banker since 1998, and I always thought I was a savvy, skeptical observer. But I have to admit, Bitcoin red-pilled me on the banking system. To borrow another phrase from The Matrix, what if I told you that Bitcoin is what made me realize 2 years ago that real-time payments, or the lack thereof in the U.S. banking industry, was a major story? If a Bitcoin transaction could be done in 10 minutes and a Ripple transaction in seconds, it seems strange that the industry could not agree to move to same-day transfers. American Banker's reporting on the large banks' resistance to faster payments won an award in 2013 from the Society of American Business Editors and Writers. More recently, the industry seems to have found religion on faster payments after some nudging from the Fed. I suspect that Bitcoin, simply by existing and working well enough, played some small role in this sea change. What if I told you that Bitcoin is a big part of the reason I saw early on that American Banker should be paying attention to the phenomenon we now call de-risking? Bitcoin startups were one of the first categories of businesses to be treated as pariahs in recent years by the banks, fearful of the compliance risks and the more nebulous reputational risk. Since then, we've seen banks cut off relationships, perhaps reluctantly, with everyone from legal marijuana businesses to adult entertainers, in some cases churches. Apparently, the tithe means that a church handles a suspicious amount of cash. In the most dramatic example, the de-risking of money transmitters that facilitate transfers to Somalia is feared to be causing a humanitarian crisis in that country. And I will proudly note that American Banker's coverage of the dilemma facing banks in that situation has been nominated for a couple of business journalism awards as well. Bitcoin was born of the internet. On the internet, neutrality is a great virtue. In the financial system, neutrality is an unspeakable sin, and discrimination of certain kinds is mandatory. Software does what you tell it to do. It doesn't care whether you're Jamie Dimon or the pizza delivery guy. Financial intermediaries, on the other hand, are increasingly expected by their regulators to not only know their customers, but also their customers' customers, and their customers' customers' customers. They are expected to block transactions to certain countries. They are told by their examiners to manage the reputational risk of doing business with certain perfectly legal industries, which in practice has meant de-risking. The red pilling goes even deeper. What if I told you that the infamous pseudonymity of Bitcoin was not just a risk to be managed, but perhaps, a freedom to be protected? Just to be clear, I am a law-abiding citizen, and I lead a dull suburban life. But I believe that the cryptocurrency community is doing important R&D for a cashless future. I take it as a given that physical cash is going to fade away, possibly in our lifetime. This is mostly a good thing. Think of all the transactions that don't get done because someone didn't have exact change. Think of the costs of armored trucks. But I believe that there needs to be some place in the future for anonymous financial transactions, at least on the low end. If all our everyday transactions are cataloged in databases and linked to our identities, the implications are chilling. I recognize that there are nasty people out there who are using cloaking tools to do terrible things. And there was a very good story in the New York Times over the weekend about these ransomware rings that are using Bitcoin because of the difficult-to-trace nature of it. But I don't accept the claim that only criminals have a use for this. For every bag of bills that is used to pay a ransom, there are countless individuals who use small amounts of cash to pay for perfectly harmless purchases that they'd just rather not have anyone know about. It could be a home pregnancy test kit or a pack of cigarettes. Think of all the cash transactions you've done throughout your life. Would you want every single one of those, no matter how small, on file somewhere and tied to your name, just in case the government needs it later? At the very least, the industry and this country should be having a candid and open debate right now about financial privacy. And I believe it should be informed by the public conversation about the Snowden revelations and the Fourth Amendment. It's questionable whether Bitcoin, as it stands, is compatible with existing regulations. And that's true of a lot of cryptocurrencies. But what if I told you that maybe, just maybe, it's the regulations that need to adjust? It stands to reason that money laundering, defined as concealing evidence of criminal activity, is itself a crime. But should it be a crime to cover up actions that are not themselves illegal, simply because doing so may inconvenience law enforcement? I would never have asked myself questions like this were it not for Bitcoin. I have no idea how successful Bitcoin will be in the long term, but I do know that the red pill will never wear off. While recognizing the reality of regulation, I would still urge everyone to question the things that don't make sense to them, to challenge the supposedly immutable consensus about what cannot, will not ever change. Whether you're a banker wearing a suit or a technologist in cargo shorts, let's all take the red pill together. So that's enough of my spiel for one day. Now I'd like to introduce our first speaker. Blythe Masters is the CEO of Digital Asset Holdings, a startup launched in March 2015, which is using digital technology to enhance settlement and recording of digital and mainstream financial assets. She was also recently named the chairman of Santander Consumer USA, which I hope I pronounced correctly. It's a unit of Banco Santander of Spain. Blythe was previously a senior executive at JP Morgan Chase, which she left in 2014 after a career spanning 27 years, following the successful sale of the bank's physical commodities business, which she built. Ladies and gentlemen, please give a warm welcome to Blythe Masters.
Thank you, Mark. Good morning, everyone. And yes, you did pronounce Santander Consumer USA correctly, but that's not what I'm going to be talking about today. Interestingly, I learned a couple of things from your speech already this morning. As you heard, until relatively recently, I was working at JP Morgan Chase after a long career there, almost 30 years. And towards the end of last year, after I sold the business that I was then running for them, I took some time off and had every intention of minding my own business for at least a year. And during that time, I undertook a regime in pursuit of greater health and a return to youth. And one of the things I started taking was a little red pill. Now, I was under the impression that it was a vitamin, or maybe had something to do with iron, but it turns out apparently it was something entirely different, because I wake up a few months later and find myself CEO of a very small company, a fintech startup, messing around in the distributed ledger Bitcoin space. And what a ride it has been. So, why on earth would I have done that? Simply put, because I believe that this technology has the potential to truly change the way that the financial world operates in a very profound sense. It offers the opportunity to reduce costs, to improve efficiency, to reduce risks, and overall provide a better customer service, which ultimately is what financial services needs to be all about. Over the years, I was lucky enough in my roles at JP Morgan to have the opportunity to innovate in a number of different areas of business. And in thinking about what I would do next, I really don't think I could have happened upon something more fascinating and more enjoyable than the opportunity to innovate again in a new space that I believe is genuinely going to be game-changing. So first of all, let's talk a little bit about what's the problem. Occasionally, you get exposure to technologies that really are great ideas, they're cool, but they're looking for problems to solve. And generally when that happens, they don't catch on. They might be cool, but they don't have a purpose in life. The thing about distributed ledger technology today is that they're great ideas, the technology is in fact cool, and there are some very significant problems to which they can be applied and which can be addressed. At its core, one of the most obvious problems in financial markets infrastructure that we see the opportunity to tackle is the simple fact of settlement latency. That's delay in the final transfer of assets which have been committed to change hands but have not yet actually done so. As you know, transactions today operate at warp speed. We read books about flash boys. We understand about competitive advantages that are measured in nanoseconds or fractions thereof, and yet the back-end processing of financial transactions takes days or even weeks or even months. U.S. public equities still operate on a trade date plus 3 days lag basis. At the other end of the spectrum, syndicated corporate loans, which is not a small backwater, by the way, it's a $2 trillion plus notional market, operate on a trade date plus 20 or more days. In other words, by appointment. So why would one believe that infrastructure in back offices, in post-trade processing, would suddenly change, having been the way that it is for decades? Why would it spontaneously evolve into a new and better state? As I said, a cool technology may not be sufficient catalyst for change. Sunk costs, operational complexities, regulatory requirements, all of these make change extremely difficult to effect in financial infrastructure. But the fact is that financial institutions today are operating in an environment where change is, simply put, an imperative. And now there's the real opportunity for technology and technological innovation to actually make a difference. To put this in context, as we all know, going back a few years to 2008, interconnectedness across counterparties and opaqueness in financial markets very nearly brought the world to its knees. In the aftermath of the financial crisis, extensive reforms have been introduced with the intention, by and large, of reducing systemic risk. Many of these reforms have met their objectives with generally positive results, not all of them. Most notably, the banking industry is today materially less leveraged than it was in 2008. However, these same reforms have also created some new and some different risks. For example, the mandated central clearing and execution of derivatives and reduced risk and balance sheet capacity of banks have brought about some unintended consequences, including greater central point of failure risk, concentration of activity, and reduced liquidity, as you already heard about from Marc. First off, capital requirements have risen with the result that any instrument that resides on a bank's balance sheet for 1 iota of a second longer than it possibly could is acting as a drain on the ROE of the institution. At the same time, costs associated with operational and regulatory compliance have skyrocketed. Banks are increasingly spending a significant portion of their operational outlays on the generation, dissemination, communication, reconciliation of gigantic quantities of data, and it's expensive. Regulators are increasingly focused on the transparency, the speed of reporting, the degree to which assets are properly segregated, and the way in which these complex financial institutions and all of their data can be safely resolved in the event of failure. Systemic risk associated with settlement latency and lack of resiliency in infrastructure are sources of risk that, not surprisingly, these same regulators are deeply uncomfortable with. And as a result, they're increasingly putting pressure on firms to tackle these as quickly and in some cases more quickly than the currently enabling technology will realistically permit. Finally, and needless to say, in this increasingly electronic world, operational resiliency and vulnerability to cyber attack are critical considerations for any major financial institution and their regulators. Today, the big firms invest heavily in perimeter security arrangements behind which they guard their precious data about you and me. And yet those perimeter security arrangements are increasingly porous, it seems. Every day we read another story about how they have been compromised. Legacy financial services infrastructure keeps data unencrypted, centralized, and generally uses hub and spoke models where enormous costs are incurred in transmitting, synchronizing, and reconciling data within and between different institutions. And it's vulnerable along the way. As speed, complexity, volumes mount, the costs of people, computing, electricity, carbon, need to grow, as does the vulnerability to attack or failure. So it's in that context that when I had my aha moment thinking about distributed ledger technology, or perhaps when I took that little red pill one too many times, I became to believe that this innovation had really very significant implications. So what on earth is a distributed ledger? Well, you're all here to talk about the Bitcoin blockchain, and so you've certainly heard of an example of a distributed ledger. There are others, and I'll come back to those, but you can think of the broad family of technologies as being innovative, networked databases. Pretty simple. They operate according to protocols that are disseminated using open source, in an open source fashion, whereby generally anyone with the qualifications can independently examine and understand the underlying mathematics. They're decentralized, not centralized, meaning that you have a network with different processing points or points of access that can exist in different locations, different time zones, within different legal entities, or even just different places within the same legal entity. They're also generally accessible by multiple parties that can each access the same single prime record, golden ledger, if you will, providing that they have the adequate credentials. And this can include regulators, not just financial institutions and their customers. What's also important relative to the old-fashioned hub and spoke model of financial infrastructure is that this environment is generally encrypted. Ledgers are cryptographically secured, And they're resilient because if any one point in the network fails, there are other points which are able to pick up the slack. Every participant in the network has a replicated version of a transaction database. And you can think of this as being analogous to the way that the internet works today. It goes without saying that you need to be confident that the truth is in fact the truth when it comes to sharing and replicating databases. In the case of the Bitcoin blockchain, the ledger represents an incorruptible record of truth because of mass collaboration by different computers that constantly validate that version of the truth. This process is known as proof of work, whereby computers are playing a game of solving a mathematical puzzle that can only be solved by brute guesswork, something obviously that computers are well situated to do. The success of the Bitcoin blockchain in this context results in the reward of a native currency unit, a unit of account, otherwise known as a Bitcoin. These can, of course, be exchanged directly between peers using the Bitcoin network. And so this is why when you first learned about this topic, without realizing it, you probably heard first about the excitement regarding new cryptocurrency payment mechanisms as opposed to the underlying distributed ledger technology that enables them. I would venture to suggest that both of those are equally exciting and equally profound developments in their own distinct rights. This technology has far broader implications than merely the application to payments and cryptocurrencies. It permits us to imagine a financial system where costs, risks, and inefficiencies, the nature of the ones that I've described, are drastically reduced, where transactions can be incorruptibly recorded in a cryptographically secure manner, and where there's no single point of failure. Instead of each entity keeping its own record of events, of transactions that it's done with each other entity, and each of those working constantly to reconcile that information with each other and through time, and to disseminate that information both within their own firms and across legal entities, there's a shared ledger, or the opportunity for one, on which all participants may access the information pertinent to them. This system is in sync by design. No more reconciliation costs. You kind of have to have lived in financial services to understand the profound implications of that statement. Now, the brochure for today noted that this recent explosion of different cryptocurrencies and protocols has raised a series of fascinating questions. For example, there are debates amongst those who believe that the Bitcoin blockchain has some limitations. And indeed, that is correct. Nothing in life is truly perfect, yet. Proof of work does indeed chew up a lot of electricity and computing resources. But if you were merely prepared to trust the others in your network, you could avoid that spend, goes the debate. Unfettered access demands the need for extraordinary resiliency in the event that bad actors are attempting to penetrate your system. And yet, at the same time, unfettered access exposes users to the reputational risk of affiliation with the unknown, the unconscionable act that Marc mentioned earlier. Thus has been built the case for private or permissioned networks, where the processing parties who participate in maintaining and validating data on the network are limited to known and or trusted entities, for example, a group of highly regulated banks. And so the idea of a distributed ledger has evolved in the direction of restricted access, lower cost, and greater control. This is, of course, an anathema for those who envisioned the blockchain as the antidote to trust-based systems. And indeed, there is a trade-off between the degree of resiliency that permissioned databases can offer in the face of concerted attacks and the degree to which access can be restricted. So, thinking carefully about the trade-offs between permissioned versus non-permissioned networks is one of the key debates in this space. It's important to be aware, as you think about this, that there is more than one distributed ledger technology. Not all of them share the same strengths and weaknesses, and furthermore, that the thinking in this space is evolving very rapidly. There's no doubt in my mind that there are roles in life for both types of technology. So, How can a distributed ledger be used to tackle settlement latency in a mainstream financial market? In short, because such a ledger can be used to embed encrypted data describing a financial asset, or indeed, more or less anything of value for that matter. Not just the financial asset, but the evidence needed to prove rights to its ownership or title. Once an asset has been digitized, title transfer can occur in real time on the distributed database, which then provides an immutable, auditable track record of ownership to the parties that need to know about this. This means that the entire life cycle of a financial trade, including execution, netting, reconciliation, can occur at the trade entry level, reducing errors, risks, costs, and fails. These ledgers also have the capacity to be programmed to do quite sophisticated financial operations where applicable, and to do that automatically in a concept otherwise known as smart contracts. So thinking through what I've been talking about here, I think it should be fairly obvious to those of you familiar with financial markets that the potential addressable markets for these types of technology are absolutely gigantic. We're talking about markets that generally are measured in the trillions of dollars, not the billions or the millions. Equities, derivatives, loans, bonds, the list goes on. The costs associated with inefficiency in record keeping, in reconciliation, settlement, and operations in these markets are equally enormous. And this in the context of an industry that is under unprecedented pressure to reduce its operational costs. The opportunity to release scarce balance sheet for financial institutions, to reduce costs associated with manually intensive processes, and to provide a quicker, better, cheaper service to customers is extremely significant. And this, of course, is why so many firms in the financial services sector, banks included, are proactively exploring this area. However, in reality, the world is not there yet. In fact, we're a long way from this futuristic scenario where our financial ecosystem operates on distributed and shared ledgers. There are real frictions that exist between the digital world and the world of mainstream financial infrastructure. Minor details, like the fact that the cash that we use is fiat cash and resides in bank accounts and not on digital ledgers. There are many good questions that have to be asked and properly answered. How ready is the technology for mainstream application? Can it really handle the throughput needed to process hundreds of thousands of transactions in very short periods of time, millions of transactions per day? How do we handle the onboarding and the offboarding of assets into new systems without destroying their clean title? How do we arrive at appropriate levels of standardization amongst multiple different impacted parties seeking to share and leverage the same information? And how will regulators respond to all of this? It's in their interest to see it done well. It's most certainly not in their interest to see a road wreck. Some firms, including my own digital asset, about which I have spoken very little this morning because this is not the right forum for an advertisement, exist specifically to bridge this gap between existing real-world infrastructure and the new evolving digital marketplace. Financial markets are regulated heavily for very good reasons. Distributed ledgers have the power, used correctly, to improve transparency for all participants, including regulators, and to allow existing firms to do a better job of what they already have to do today. The functions associated with tracking, reconciling, auditing enormous amounts of data are not going to be disintermediated away. They have to continue to exist. They just need to be done more efficiently and at lower cost, and with fewer errors. So in order to progress this vision of a world that is based on digital technology, we need to be communicating with the existing legacy of financial infrastructure in order to start building those bridges between the old world and the new. It's important that we are respectful of that existing infrastructure because it works today to a degree, and it has to work. It involves very significant risks if you disrupt it. And there is no one better than the banking community to understand that point. The legal framework that surrounds the way that financial markets work has not yet evolved to fully recognize the opportunities and the risks associated with digital assets. And that needs to evolve in order to achieve this transition. But building those bridges is how we are going to evolve to a more digitized and a more efficient system. I'm completely convinced that these distributed ledger databases will be a feature of the future. And it will happen simply because it's in the best interests of absolutely everyone for that to occur. It's going to be hard, it's going to take a while, and it may involve more costs in the short term than it saves in the long term. But it is going to happen. We won't get there overnight, but it is underway. There are experiments going on in every corner of the globe with every major financial institution, with startups and gigantic technology companies involved, alongside each other, working together in ways that actually is relatively unusual relative to recent history. So just like the internet in the early 1990s, this distributed ledger technology, the internet of money, the internet of value, has the potential to be highly disruptive of certain business models. But just like the internet in the early 1990s, it also has the potential to be highly empowering of others. Distributed ledgers are going to change the way that the financial ecosystem works. How seriously should you take this? About as seriously as you should have taken the internet in the early 1990s.
This episode of Let's Talk Bitcoin is brought to you by the LTBN, the Let's Talk Bitcoin Network, which is in the process of putting together a network-wide store to allow content creators and members of the audience to potentially list and sell goods and services in exchange for US dollars via credit card, Bitcoin, shapeshift altcoins, and of course, tokens, including LTBcoin. If you've got goods or services you'd like to offer to the community, send an email to adam@letstalkbitcoin.com. The magic word for today's show is bank. That's B-A-N-K. Bank. You've got until the 8th of August to visit letstalkbitcoin.com or the Let's Talk Bitcoin iOS app to enter it for your share of the listener rewards. That's all for today. Let's rejoin Blythe now for some Q&A.
Hi, good morning. Ingrid Busaha from Morgan Stanley. Question for you about, based on what you know, of course, given your long history in financial services, what you know of the technology and how slowly certain things change, do you have a sense of timing of how long this will take to integrate?
Yeah, I do. And the good news is I'm going to give you such a nuanced answer that I can't be wrong. I've learned that trick over the years. So I think the important thing to know is it's starting now. Okay, so the amount of work that is underway, experimental and otherwise, is really very significant. Involves a lot of money, a lot of people, and a lot of focus from some of the most sophisticated financial institutions on the planet. Not to mention some of the most gifted developers in the world who don't necessarily like to feel that they're aiding the financial institutions of the planet, but nonetheless have managed to do that somewhat against their original best intentions. I would say that given the nature of the infrastructure as it exists today, the incumbent motivations, the sunk costs, the gigantic nature of some of the markets we're talking about, it would be unrealistic to expect anything approaching a full revolution in less than a decade. But the process is going to be gradual and incremental. And what we're already seeing today is people identifying and ring-fencing subsets of broader asset classes, deploying, which can be safely circled off tackled in isolation, run in parallel, in order for experimentation and understanding of the challenges and opportunities of this technology. We're seeing that happen already. There's also an entire spectrum of financial market structures that lend themselves differently to the deployment of these technologies. There are some markets, public equities markets, for example, with gigantic existing infrastructure, highly centralized regimes, centralized exchanges, clearing and custodial entities, central securities depositories, layers and layers of intermediaries, brokers, custodial agents, etc., where there is enormous challenge in taking and lifting and dropping such a complex ecosystem from where we are today to where we could imagine all of those different entities living on one single distributed ledger. By contrast, there are other markets which don't have anything like that degree of centralization and integration. So think of the securitization markets or any of the markets with relatively paper-heavy, documentation-heavy, illiquid types of underlying asset ranging from syndicated loans to commercial real estate, so on and so forth. And so you're already seeing different levels of experimentation going on in different asset classes depending on the features of those, and it makes complete sense that people would try to identify those areas which are manageable in scope, manageable in transaction volume, throughput, and frequency, manageable in terms of existing market structure, and working to advance those use cases first. And that's very much what we're seeing. So it's starting now. It's underway. I think there really are very few major firms that aren't focusing very significantly on this. And I think those that aren't are at risk of being left behind. There's a question over here, if there's a mic. Oh, there, okay.
Hi, thank you so much for talking. You were talking earlier about how doing things on the public blockchain known as Bitcoin exposes you to some risk because of the ability of unknown actors to play on that blockchain. I think that was kind of a recasting of what you were saying. Correct it if it's wrong. But my question is, on a permissioned ledger, do you believe that you're exposed to less risk as a banking entity, and how, like in particular, your team is working with permissioned ledgers? How are you guys dealing with the risk of settling on permissioned ledgers as opposed to like the Bitcoin blockchain?
Yeah. So I think what I said was that there is the potential for the reputational risk associated with being unable to identify who are entities that you may have created a transactional dependency on in using a purely public blockchain. So I wasn't referring necessarily to the risk that you might trade with someone that you don't know. There are ways to prevent that from happening. But rather that you might create a dependency on transaction processes that are less directly known to you or under your control than you're accustomed to when you call up Amazon Web Services and you have a real contract and someone to interact with directly, and thereby able to complete your KYV process satisfactorily from the point of view of an interested regulator. It really, in terms of what the right choice of an alternative ledger protocol involves, depends on the use case. It depends on the nature of the asset class, the application, your institution, your needs. In the case of my particular company, as you know, we recently acquired Hyperledger, which is a non-Bitcoin blockchain protocol, and in fact developed our earliest and some of our current working protocols on the Bitcoin blockchain. So I think it would be wrong to say that we're agnostic as to the underlying protocol. That would suggest that we're unopinionated. That's probably not quite right. I would say that we spend a significant amount of time working with clients to think through the alternatives of pros and cons of using something that is permissioned versus unpermissioned. You know, what are the vulnerabilities from a resiliency point of view? What do you give up if you move away fully from a a high degree of proof of work required in favor of something that ultimately needs to be protected by firewalls and within a network of trusted counterparties, where ultimately the question is, I'm pretty sure that most banks are willing to trust that other similarly situated banks want to do the right thing, but I'm not sure that all of us, or all of you, I should say, you can take the girl out of JP Morgan, you can't take JP Morgan out of the girl. All of you... all of you are probably not willing to take it on trust that all of you are able to be sure that you're not under the influence of some malicious actor that has compromised your infrastructure. So these are complicated, serious, to Mark's expression, grown-up discussions that need to be had in an unemotional fashion. They're about choices of balancing risk and reward. They're about technology, performance, resiliency. They involve regulators, and that's how we think about these topics as we navigate those quite complex decisions, which generally lead you in different directions depending on the use case that you're contemplating.
Hi, Chris Church with Swift. Thanks for your talk. I've heard you use the analogy of the internet back in the 90s. And back in the 90s, we were looking at the internet and we were seeing email, we were seeing news, maybe, and a few other things. The roadmap for the distributed ledger in financial services, where do you think it's going to have its first material impact? And what do you think what are the signs that we should be looking for to see that adoption is actually taking place?
So if you define material as being applied to large dollar values or large values of transactions, my guess is that it's going to be in post-trade processing rather than payments or other applications. Of securities, derivatives, financial instruments, let's call it, a little broader perhaps than just securities. And the reason why, well, they're wholesale markets, they are gigantic numbers, they do have serious challenges today. The costs associated with processing those businesses are rendering those businesses essentially uneconomic given the current cost of bank capital.
And will you need to have a CSD, for example, to take on that challenge, or can the banks do it independently?
There are various paths in that direction, but certainly I would venture to offer the fact that the CSDs are in a unique position to address that question of onboarding and offboarding, on-ramping and off-ramping of assets in order to avoid contaminating clean title and running afoul of the law. Bear in mind that CSDs, for example, in this country enjoy a very privileged position in the law, which of course you will know and understand. I would very much hope and expect to see that custodians, clearing agencies, and others adopt and start to leverage this type of activity, and it's absolutely the case that many of them are exploring this with great interest for precisely that reason. Others may come and displace them. It will be an interesting race as to how that balances out. It's okay if you're just a technology company. Sell solutions that help with that in different directions.
Thank you.
Mm-hmm. I think we're out of time, yeah? One more. Okay, one more.
How do you see permission ledgers working in a scenario where, say, an untrusted bank in Venezuela wishes to transmit value to an American bank? Is that an appropriate tool for that function?
I'm really sorry. Could you say it again? I couldn't hear you.
Sure. How do you see permission ledgers working in an environment amongst untrusted actors? Say a Venezuelan community bank wishes to transmit value to the United States.
If you can't, the point of permission network is you must choose members that are trusted. So I would say in that example would be a good example of a use case where that would not work.
Would Bitcoin work for that scenario?
Absolutely.
Okay.
Yeah. I'm absolutely not making claims that the Bitcoin blockchain serves no useful purpose in life. That's absolutely not what I believe, nor what I intended to convey. I got the thumbs up from a hardcore guy there. Okay, thank you.
Thanks for listening to this episode of Let's Talk Bitcoin. Content for today's show was provided by Blythe, Mark, and was captured by Chris DeRose. To watch the slightly longer video from which this audio was excerpted, check out the embedded video in the show notes at episode 235 at letstalkbitcoin.com. Music for this episode was provided by Jared Rubens and General Fuzz. As an aside, if you've got a Tokenly token, you can now use it to access the chat transcripts from the servers where we're essentially doing all of the development for the Tokenly project. To visit them, you need to verify your address that's holding your Tokenly tokens to your letstalkbitcoin.com account, and then visit our forums, looking for the 5 private Tokenly boards at letstalkbitcoin.com. I'm updating the transcripts about twice a week at this point. Right now, the most exciting thing in the recent batch of chats, to me at least, is the work we're doing on the SwapBot API that'll allow customers to search, buy, and track orders from vending machines entirely within the wallet itself without ever having to visit the webpage. Anyhow, thanks for listening. See you Tuesday.